Hey guys, and welcome back to another video. Today we're going to be talking about higher time frame trading, but don't worry, don't switch off the video yet. With higher time frame I mean especially the 15-minute time frame. Oh, now some people will say, oh, that's not really the higher time frame. Well, I currently see where the trend is going with that new shitty ICT Sun 30-second model. I think that's bullshit. If you cannot trade profitable on a 15-minute time frame, you will certainly not be more profitable on a 30-second or even lower time frame. I saw some people on Twitter using a 1 or 5 seconds time frame. It's really absurd. And yeah, let's jump right into TradingView to see what the 15-minute time frame, specifically looking at the 2022 models on the 15-minute time frame, can do for you trading 4 hours per day. And if you want access to the template where I tested this entire 15-minute strategy on ESZ 2023, make sure to join us on Discord. I posted it in the general chat. And if you don't know what the 2022 model is yet, I have made a very clear ICT for Beginners video, actually the first one of the ICT for Beginners series. There's a link for it in the description box below. Make sure to check it out if you haven't seen that. It really doesn't make much sense watching this video before that. So here we have the S&P 500 futures contract chart. We're looking at a 15-minute time frame, and I specifically only looked for opportunities within the 3 to 5 a.m. London kill zone timing window and a 9:30, so right at the New York Open, until 11:30 a.m. timing window as well. And what we really want to see using these setups is, or what I specifically looked for is, we want to see the setup forming at the high of the day. Doesn't have to take out liquidity above it, doesn't always do that. If you like to add that into your rule, that the high before 9:30 has to be taken, okay, then put that into your rule set. And you, for example, wouldn't take this setup. It's very simple. I would take a setup like this because we had nice and clean market structure with higher highs and higher lows prior to the New York Open. New York opened up, took this low, but I have to wait for my confirmation with a close below the most recent higher low. Right here, higher low, higher low, higher low. Basically a low where you do not have, let me zoom in here, where you do have a higher low to the left and a higher low to the right. So it's just a wick all by itself. If you have like equal lows, that counts too. But right here we have a higher low to the left and a higher low wick to the right. And right here that's the higher swing low. If we would draw our path tool here, we would be looking at a up move, a pullback, a up move, and we pulled back on the same candle, a continuation. Well, we could draw the continuation till here, a pullback, a last higher high, then we swept this low, we pulled back. That's the New York Open volatility. But the beautiful thing here on the higher time frame is you don't get bothered by it, because all you wait for is your candle to close below this low. This is our most recent higher low, and for the valid 2022 model, that's what we're waiting for. Price could consolidate for this entire session where we even consider to take an entry. So let's say you are for example at work and you can't check the 1 minute time frame, which is, I don't know, on the 1 minute time frame I'm pretty sure we would have seen many different opportunities in here. And even if they doesn't match our rule set or whatever, it's super easy to get triggered into a position because you believe, oh, I know I studied ICT concepts, blah blah blah, I know how price is being booked. And specifically that is more dangerous than you might think. I've been in that same position where I'm on the 1 minute time frame or even lower, thinking that I know what the market is going to do 100% of the time because I studied ICT concept, and that's something that's getting imprinted on you. Okay, I know what the marketplace or the S&P 500 is going to do 100% of the time. And that's more dangerous than beneficial, because in reality, you do not know what the market is going to do. 100% of the time. Otherwise, you would already getting these Apex, Topstep, or Take Profit Trader payouts. You'd be chilling, you wouldn't be watching this video. The solution, in my opinion, is to go to the higher time frame, trade less. Yeah, it's more boring, but really trading shouldn't be super exciting. You wait for your setup to appear. If it doesn't appear, you don't trade, period. And right here on a 15-minute time frame, we see how perfectly it's playing out. My rule is I want to see a close below the most recent higher low coming from the current high of the day, right here. Where did the day open? Right here on this vertical line at 6 p.m. New York local time. That's where the new daily candle opened up. Right here during the London session, we came from the low. We had our market structure shift, leaving behind a nice inefficiency at that 2 a.m. opening. And until London open, we retraced into this bullish fair value gap. We got filled. Because it's so big, I would only consider taking an entry on the 50% of that fair value gap. And we go long. We hit a 2-to-1 risk to reward. While you are looking at the 1 minute time frame during the London session, taking a long short, long short, long short, long short, long short, because you see so many opportunities down there. We continue to trend higher. And on a 1 minute time frame, you would likely see a market structure shift right here to go short, and right here, and right here. And every time you get stopped out, wondering why it doesn't play out. Well, that's the solution. Go to the higher time frames. The higher time frame kept on making higher lows and higher highs until coming off the current high of the day, formed here at 9 a.m. New York local time on this 15-minute candle. And from here on, continued lower. Didn't hold this bullish fair value gap right here. We had a little bit of indecision right after the 9:30 a.m. New York open, consolidated, but eventually we closed below the most recent low right here on the 15-minute time frame. And what did we leave behind? A beautiful bearish fair value gap. We enter right on here, put our stop above the 9 a.m. high, 6.5 points. That's not too bad for a higher time frame. 4.75 points is also not too bad. You usually don't get better entries on a 1 minute time frame, in my opinion. And we hit a 2-to-1 risk to reward super easily. And you might be thinking this only happens every maybe once or twice per month. No, you're wrong. Like I said, join our Discord if you want this entire template. Right here, here another day, right here during London, here during New York. Here we had a very beautiful setup. We formed a low. 9:30 takes out the low of the day, displaces, bullish fair value gap, continuation to the upside within our 2-hour timing window. Right here, coming off the high of the day, going below the most recent low, inversion fair value gap, continuation lower. Let's see if we find another nice example. Here we actually took a loss. We had our market structure shift coming from the high of the day. Here we can actually see that 9:30 opening candle took out buy side liquidity above this 8:15 a.m. high, put in a low, closed below this low, so we have our valid market structure shift, and we also had our bearish fair value gap, but this time it didn't play out. The trend was just too bullish. And let's see, for example, right here, this happened post. Now that also happened within the New York Hill Zone. We got our setup prior to it. And if you want to learn more about all this and how I do this in a live market, I actually stream live every day for free on YouTube with ads and a little bit of a delay. And if you do not want to see those ads or the delay, you can join my Patreon and join the VIP Discord section where I stream live every day, doing exactly what I'm talking about right here. Let's see, I think in October we had a beautiful entry opportunity. Where was that? But you can see how often this happens. Of course, it's not always gonna look the same, but most of the times the logic behind it stays the same. Yeah, this was perfect. Right here, we had the London session low. During the London session, we did not even get an entry. That's completely fine. We pulled back, we formed a lower low, and then we look at this low and our most recent lowest low, and we look for the highest point between these points. This becomes our pullback right here. We continue lower, pullback, we continue lower, and between those two lows, we look for the highest point, which is this high right here. to become our lower high. We pull back, we make a lower low, and then we just place above it, closing above it here on the 15, making this a valid market structure shift. And what do we leave behind? A 15-minute fair value gap. On the 1 minute time frame, I remember this because I traded it live. We had fair value gaps down here, down here, down here. Even on the 5 minute, we missed the entry. On a 15, the only entry opportunity you would have and see would be right here inside this bullish fair value gap. Yes, this time the stop loss would be a little bit bigger, 25 points. But in my opinion, when we have such a big stop loss, I wouldn't go for a 2 or 3 risk to reward ratio, because you simply can't expect the market to rally up to your take profit target just because you are going for a specific risk to reward ratio. With futures specifically, if you trade a Apex funded account or a Topstep funded account, you cannot hold overnight, so you have to make sure you're out by 4 p.m. New York local time right here or around this time. You unfortunately can't hold overnight, even though it wouldn't have played out and hit a 3-to-1 risk to reward. And that's exactly the thing. So if I have a big stop loss, first of all, I always use micro contracts. But like I said here, big stop loss, I only go for 1-to-1 risk to reward. It's still pretty decent. You could go for a 1.5 if you have some target buy side liquidity. Or yeah, like I just said, you target buy side liquidity. This is the current high of the day. This is Monday. We had a new day opening gap. London continued lower. Power of 3, accumulation, manipulation, expansion paired with a reversal. So if you get your entry right here, you don't want to risk that much. You could also choose a stop loss of 10 ticks or 10 points. But then, yeah, the safe method is always to place it down here. It's very rare that a model like this fails completely. And even then, with proper risk management, you're safe and sound. Target buy side liquidity for a 1-to-1 risk to reward. 23.5 points. If you want to go take more, you take partials and you secure at a 1-to-1.5 risk to reward ratio right here. Or you simply measure from the most recent low to that lowest high and project standard deviations. Alright, so in this case we want to see how high we can potentially take this trade. So a -1 standard deviation would take us just above this buy side liquidity right here. And what I mean by this is if we measure the range from right here to right here and we copy it and put it on top of it. So this last manipulation right here once again at the 9:30 opening, which we displaced, leaving behind a bullish fair value gap. If we copy that box or the range and multiply it on top of it, this could be a very, very, very easy target for you. And based on that, then you could still recreate your risk to reward ratio if you want a fixed 2-to-1. Your stop loss could, for example, be 50% of this last down closing candle. You could use the PD array and say, okay, my stop loss should be safe below the 50% of this bullish order block. Put it a little bit below here, and then you made a 15-point stop loss out of a 25-point stop loss. There are many ways to trade it, and I don't think 100% fixed rules are the solution. But the main point I'm trying to make here is that higher time frame setups still play out very well. More often than not, and it's harder for, basically the trader or yourself to mess it up because you took the trade on a 15 and the session is done. You take a trade on a 1 minute time frame. Let's see where we're at. You see a opportunity here and fair value gaps here, and it's just too much. And I really hope you understand that, because that's what I believe why most of the ICT traders fail. They think they know what the market is going to do 100% of the time, and I think that's a very, very dangerous assumption or belief to have settled within you. And I'm only speaking from my own experiences. I don't want anyone to make the same mistakes that I already have made. If you find this video helpful, make sure to give it a like and to subscribe to my channel. And also check out the daily live streams that I do. Trading and tape reading, live price action.